So before we actually go on to the sums, I'll just take not more than 5 minutes to just quickly recap what we saw as part of the last slide in the previous lecture. So firstly, we saw that intuitively, when we think of buying a call option, the first thought that we get is buying a call option is similar to buying a share, right? Because both of them create a bullish position. But there are very important differences between buying a call option and buying a share. The first difference being that the initial payment which is required in a call option, which is the upfront payment, is very negligible versus the significant payment that is required for buying a share. We saw an example of Reliance wherein the underlying price of Reliance was 2000, and then we saw that the call option premium for buying a call option on Reliance at a strike price of 2000 was only 69 rupees, if I'm not wrong, right? So buying a call option required only 69 rupees outflow, whereas buying a share required an outflow of rupees 2000, right? So in that sense, buying a call option is significantly different from buying a share. Okay. Similarly, we also saw that in future, the payoff of a share is going to be the share price in future, right? Let's say it was a call option whose expiry was on the 26th of November. So the payoff from a share on 26th of November is actually going to be the share price itself, right? Because that is the amount that you will get on the 26th of November if you sell the share. Whereas in case of a call option, the payoff is actually going to be either zero or it will have a small positive payoff, right? The payoff in case of a share is going to be, almost going in the range of, 1800 or 2200. Those were the two prices that we took, right? So the payoff of a share is going to be either 2200 or 1800, whereas the payoff of a call option is going to be either 200 or zero, right? So, I mean, you also are able to see that there's a significant difference in the payoff from a share and the payoff from a call option. So in these two aspects, the payoff of a call option is going to be different. I mean, the characteristic of a call option is going to be different from the characteristic of a share. All right. So initially, although we thought that buying a call option is similar to buying a share, we saw that there are some inherent differences. To tackle these differences, what we said was call option can be looked at as leveraged stock buying. What does leveraged stock buying means? It means borrow and then buy a share. A call option is equal to borrowing borrowing a certain sum of money and adding your own savings to that sum of money and buying a share. All right, because when you do this, when you borrow and then invest, what you're going to ensure is your own funds, which means the funds that you have the funds that you're taking out of your savings or out of your income is going to be small, and that is going to be similar to similar to the case of a call option, because in call option also your own funds that are put into a call option is very less, right? So when you borrow and invest in a share and when you invest in a call option, the net effect is that the outflow from your pocket is going to be less. All right, and then we ended the video saying that we will look into an example. Before going into the example, I would just like to mention one thing, that although I've written borrowing and buying a share, and in the previous lecture also I had mentioned, that we will be buying one share by borrowing less than 2000. Okay. But we're not going to borrow one share. We're not going to buy one share. We will be buying a certain number of shares. Okay. So one call option, we're trying to replicate a call option using a combination of stock and risk-free borrowing. In this case, it's risk-free borrowing. Okay. If you remember over here, I had mentioned we're going to create a portfolio using stock and risk-free borrowing or lending. Okay. In case of a call option, we are using stock and risk-free borrowing. In case of a put option, we will be using risk-free in case of a put option, we will be using risk-free lending. All right. But we're not going to buy one share. Okay. We're going to buy X number of shares. Okay, what that X is, we will be calculating. Okay, so if you are actually able to imagine, there are two unknowns over here, because one, I said we will be borrowing a certain sum of money. I didn't say that we will be borrowing exactly the amount of share price today. I said the amount of share price today for Reliance was 2000. I said we will be borrowing a sum of money less than 2000. Okay, I didn't tell you how much. So one unknown is how much to borrow. The second unknown is how many shares to buy. All right. Although I kept using the word one share, in reality, it is not one share. We will see why it is not one share. It's going to be a certain fraction of shares or great, whatever. Yeah, I mean, it's going to be certain number of shares. Okay, so there are two unknowns. One is how much to borrow. The second is how many number of shares to be bought. All right, and we will be buying it. I mean, we will be combining this borrowing and this number of shares purchased in such a way that the payoff from this portfolio is going to be the same as that of the payoff from a call option. Only then you can call it a replicating portfolio, right? We were going to, at the end of the day, please don't forget the overview, right? Because overview is what is the most important. We are going to create a portfolio using borrowing and buying a share in such a way that the payoff of the call option and the payoff of this portfolio is actually equal. Okay, if you remember, we have ensured that if the, I mean, we're going to ensure that the payoff is the same as option at maturity, and once the payoff is equal, then the price of both of them should be equal. All right, the price of a call option is unknown. We will be finding the price of this replicating portfolio, and the price of this replicating portfolio is going to be equal to the price of the call option to prevent arbitrage. All right, so now let's quickly look at the numbers before we go into the example that we were having, in delta neutral approach, wherein we took the share price as 50 and then 55 and 45 as the future spot prices. Since we actually took Reliance numbers, I will actually prefer, let's work out first on the Reliance example. Although we assumed U as 1.1 and D as 0.9, which is not a realistic assumption, but just to get a hang of the numbers, it'll be a practice twice. First, let's do it on the Reliance example, and then let's do it on the example that we had on the Excel sheet. So I'm actually trying to use OneNote and a pen. If it works out, well and good. Otherwise, I will quickly switch over to the Excel sheet. Let's see, I'm myself not really sure. In case it works out, well and good. Otherwise, we'll just move to the Excel sheet, okay? Sorry for that, but I'm just giving it a try, okay? So firstly, we saw that the stock price was equal to rupees 2000. It's actually getting a little clumsy, but let's see, let's go ahead. I'll just decide whether or not to use in some time. Okay. And then we assume that U is equal to 1.1 and D is equal to 0.9. All right. So if you remember so 2000 is the current share price. It can either go up to 2200 or it can come down to 1800. And how have we got this? We did this by multiplying 2000 with 1.1, and then the bottom node, we got it as by multiplying 2000 by 0.9, right? Okay, now the value of call over here is 200 because we assume that the strike price is also 2000. Rather, this is not an assumption. We intentionally took a strike price of 2000 because we wanted an at the money call option, right? So the value of call over here will be 200. And how have I arrived at this 200? It is 2200, which is the spot price on maturity minus the strike price. This is going to be my payoff. At the bottom node, the payoff will be 0 because the call option lapses. All right. So now we have to create a portfolio. Let's say I am assuming borrow Y and buy H shares. Okay, so we had two unknowns, right? We borrow a sum of money Y and then we buy H shares. All right. If you remember, the whole point of replicating portfolio was we ensure that this portfolio of borrowing a sum of Y and buying H shares has the same payoff as that of a call option in future, right? This portfolio should have the same payoff as a call option in future, which means the payoff from this, okay, and let's assume a risk-free rate of 5% per annum, although the time to maturity was 26th of November, I'm assuming over here that time to maturity is equal to 1 month, okay? Because otherwise it will get difficult for me to calculate in the number of days, okay? So I'm assuming that the time to maturity is 1 month. Apologies for this. This is the facts. What we have over here is the facts of the question. And then the remaining is basically our solution, all right? I should have put it a little more in a proper way, but it was haphazard. Sorry for that. Okay, so we borrow Y and we buy H shares. Okay, we do this today. All right, we're doing this today. Okay, now imagine we're standing at t equal to 1, because this is nothing but t equal to 1, and this is t equal to 0, right? Let's say now we're standing at t equal to 1. What is going to be the value of this portfolio at t equal to 1? Okay, because this portfolio, we purchased it today, all right? Now we are calculating the portfolio of this at t equal to 1. Okay, if I buy H shares at the upper node, first I'm talking about the upper node, each share is worth 2,200, right? So H shares will be worth 2,200 into H, right? For instance, let's say if H is hypothetically 0.8, for instance, okay, then the value of H shares is going to be 2,200 into 0.8. If H is equal to 1, then the value of H shares, which is 1 share, is going to be equal to 2,200. All right. If the value of H is 0.5, then 0.5 into 2,200, it will be 1,100. Right. So the value of H shares is going to be 2,200 H. All right. And then I will have to repay my borrowings, right? I will have to repay the borrowings that I've took today, that I have taken today, along with the interest, right? Interest is 5% per annum, and for 1 month, it's going to be 5 into 1 by 12. Can I make it 3 by any? Okay, I'll just make the time to maturity as 3. I'm so sorry, because we have still not used time to maturity anyway, because 5 into 1 by 12 would give me odd figures. So I'm just making it 5 into 3 by 12. Okay, so basically we borrowed Y today to repay that at t equal to 3. We will have 2,200 H minus, because this is going to be a cash outflow. I will have to repay Y into 1 point, it will be 1. It will be 1 plus 0.05 into 3 by 12. Okay, because Y into 1 will give you the principal amount. I'm adding that with the interest that needs to be paid. Okay, which is Y into 1 plus 0.05 into 3 by 12. Okay, at the bottom node, this is at the upper node, right? And at the bottom node, we had H shares. H shares is now, each one share is worth 1,800. Therefore, the value of H shares will be 1,800 into H, right? Just like how at the upper node it was 2,200 into H, because the value of one share is 2,200. You have H shares with you. Therefore, the value of the total number of shares will be 2,200 into H. Over here, it will be 1,800 into H minus what you have to repay is still going to remain the same. That is not dependent on what the value of share is, right? Because today, if you have borrowed a sum of money, which is Y, at t equal to 3, you will have to pay Y into 1 plus 0.05 into 3 by 12, right? Because your repayment is not going to be dependent on how much you actually, what your share price is. Your repayment is actually going to be fixed. So if you look at this part of the equation in both the first, as in the upper node as well as the bottom node, the value of repayment is actually going to be the same. There's no difference to it. Okay, we saw that, I mean, we actually read that this portfolio must equal the payoff of a call option, right? Which means this is the payoff of a call option, right? This part of it. Okay, this payoff of a call option should be equal to the payoff of the portfolio, which means I am equating the payoff of a call option at t equal to 3 on the upper node with the payoff of this portfolio at the upper node. Similarly, At the bottom node, I have this payoff from a call option of 0. I am equating that with the payoff of this portfolio, all right? Because that is the whole point of replicating portfolio, right? So now we have two equations, two unknowns. This becomes a simple linear equation, right? Okay, so if you actually look at it, we have 200 is equal to 2200 H minus y into a certain sum of y, which is the repayment amount. And at the bottom node, we have 0 equal to 1800 H minus again the repayment amount. Okay, if you see, the repayment amount is actually the same. Okay, now if you yeah, okay, let's say this is equation 1. Let's say this is equation 1, and let us say this is equation 2. All right. So I am reducing equation 2 from equation 1. That's how you solve linear equations, right? If you have two linear equations, you actually reduce one equation from the other and you find out the value, right? So I am reducing equation 2 from equation 1. All right. What will I get? 200 minus 0, which is equal to 200. And then 2200 minus 1800, which is equal to 400H. Okay, this and this are actually the same value, right? So if I do this minus this, what will happen is this is minus y into some amount, and this will become plus y into some amount. Both of them will cancel each other out, and this will be 0 basically. So I have 200 equal to 400H, which means H is equal to 0.5, right? So I have found out, sorry, so over here, in borrow Y and buy H shares, I have found out H to be equal to 0.5. Agreed? Now I need to find out the value of Y. All right. So obviously what I will do is I will put this H into equation number 2, or you can put it in equation number 1 also. The reason why I'm putting it in equation number 2 is because the LHS is actually equal to 0. All right. So if I substitute H over here, I can easily basically calculate without doing additional mathematics, but it's going to be simple only. It's not going to be difficult, even if you put it in equation 1. Okay, so I will substitute that 0.5 into equation number 2, and then I will calculate the value of y. All right. Sorry, give me a second. Yeah. Okay, so we will be substituting 0.5 into the second equation. So what we will have is 0, or should I'll write it a little below. 0 is equal to 1800 into 0.5, which is equal to 900. All right. And then we have minus y into 1.0125. All right. Because 0.05 into 3 by 12 is 1.125. Is it? It's 1.25, right? Yeah, is 1.25 percentage. And then that multiplied by that added to 1 is 1.0125, which is 900 minus y into 1.0125. Apologies, this was actually stupid, right? I mean, why did I even have to do it? Okay, 5 divided by 4 is 1.25. Yeah, so 900 minus y into 1.0125, and then this we can transfer it to the LHS, which will be 1.0125 y equal to 900, and then the value of y will be 900 divided by 1.0125, which is 889. Okay, so if you look at it, what we actually did was we said we are going to create a portfolio by borrowing Y and buying H shares. There were two unknowns, and we wanted this portfolio to replicate the payoff of a call option. Okay, so what we did was we calculated the payoff of this portfolio at t equal to 3. The payoff of the portfolio was nothing but H number of shares into the share price at t equal to 3, which is 2200H and 1800H. From that, we reduced. Why did we reduce? Because we will have to repay the borrowings. In case of this part, we will sell the shares and this is a cash inflow for us, right? At t equal to 3. If you're buying shares today, if you're buying H shares today, you can sell H shares at t equal to 3, right? So at t equal to 3, 2200H is a cash inflow, whereas this is a cash outflow, right? So 2200H minus Y into 1 plus 0.05 into 3 by 12. 0.05 was the risk-free rate for 3 months, all right? So we multiplied that with 3 by 12 because 5% is per annum compounded quarterly. So we multiplied that with 3 by 12 to get 1.25% for 3 months. So 1 plus 1.25 was 1.125, which we saw over here, 1.0125. And at the bottom node, similarly, we have 1800H minus Y into 1 plus 0.05 into 3 by 12. Okay, and then we equated the payoff of the call option with the payoff of this portfolio, because we wanted a replicating portfolio, right? We want this portfolio to replicate the payoff of the call option. We had two unknowns, two equations. On solving it, we got H as equal to 0.5 shares and we got Y as 889 rupees, right? It is 888.89. I just rounded that off to 889. Okay. So if you actually ask me, the replicating portfolio is borrow 889 and buy 0.5 shares. Okay. So today, if you actually borrow 889 and buy 0.5 shares, the payoff of this portfolio is going to be the same as the payoff of the call option, which means if the payoff of the share price at t equal to 3 is going to be 2200, the payoff of the call option is going to be 200, right? The payoff of this portfolio will also be 200. Okay, obviously it is going to be 200 because 889 and 0.5 shares have been derived by equating the payoff of the call option with the payoff of this portfolio, right? But if, for your satisfaction, you can obviously check. It will be 0.5 into 2200 at the upper node minus 889 into 1.0125. Okay, you know, if you actually ask me quickly, it will be 2200 minus 0.5, which is be 1100. Okay, and the future value of this 889 multiplied by 1.0125 is going to be equal to 900. So 1100 minus 900 is going to be equal to 200, which is nothing but the payoff of the call option at t equal to 3. Similarly, if the share price is 1800 at the bottom node, the payoff of the call option is going to be 0, and the payoff of this portfolio will also be equal to 0. How? You will have share price as 1800, so the value of 0.5 shares will be 900. The value of your borrowing will be 900. The value of borrowing is not going to change on the basis of share price, right? So 900 minus 900, the value of this portfolio is going to be equal to 0, similar to the payoff of the call option, right? So this portfolio is nothing but a replica of the call option, okay? Now, if two portfolios have the same payoff in future, they have to have the same price today, which means this portfolio has the same payoff as that of a call option, which is either 200 or 0. So the price of this portfolio should be equal to the price of the call option today. Okay, we do not know the price of the call option. So what we are going to do is we will be calculating the price of this portfolio today. Apologies. We will be calculating the price of this portfolio today, and that will be equal to the price of the call option. Now, how do we calculate the price of the portfolio today? Okay, price of the portfolio today is nothing but the cash inflow or the cash outflow that you have today, right? For instance, let's say you're borrowing 889. When you borrow 889, you have a cash inflow of 889, right? Okay, this is cash inflow. So I'm denoting it by plus. Okay, and then if you want to buy 0.5 shares today, you will have a cash outflow of 1000 rupees. How did I get that 1000? The value of one share today is 2000. So the value of 0.5 shares is going to be 1000, right? So today, you have a net cash outflow of 889 minus 1000, which is equal to 111, right? Yeah. Okay. So the price of, so this is a cash outflow. Okay. So the price of this portfolio today is nothing but pay a cash outflow of 111, right? So to buy this portfolio today, you need to pay from your own savings. Remember, you're buying 0.5 shares, which is 1000 rupees, but you're only borrowing 889. You're not borrowing the full sum of money. You're still paying some amount from your own savings or your own income. And that amount is actually 111, right? So 111 is the cash outflow from your own savings. This 111 is nothing but equal to price of the option today. Price of the option is nothing but premium, right? Premium meaning what the holder should pay to the seller, what the buyer of the option should pay to the seller. Okay, so what we exactly did was, one, we first created a portfolio whose payoff was equal to that of a call option, right? And we assumed two variables in that. One, we assumed that we would be borrowing a sum of Y. And second, we didn't say that we will buy one share. We said we will buy only 0.5 shares, or we will buy H shares. All right. So we are borrowing Y and we are buying H shares. Okay. Now I want this portfolio to replicate the payoff of a call option. Okay. I know the payoff of a call option at T equal to 3. The payoff of a call option at T equal to 3 is going to be either 200 or 0, depending on the share price, right? So what I then did was, I calculated the payoff of this portfolio and then I equated that to the payoff of the call option. Okay. Then after that, I found out the value of H and the value of Y. The value of the maturity value of Y, or the repayment proceeds of Y, is going to be the same whether the share price is 2200 or whether the share price is 1800, right? Because what you repay as principal plus interest is not going to be dependent on the price of the share, right? So H we found out was equal to 0.5, and then we found out Y to be equal to 889. All right. 889 is Y, which is nothing but the amount of borrowing that I make today. The repayment is going to be 889 into 1.0125, which is nothing but 900. Okay. So I'm borrowing 889 today and I'm repaying 900 at T equal to 3. All right. So my portfolio, which replicates the payoff of the call option, is going to be borrow 889 rupees today and buy 0.5 shares. Okay. We saw that to buy 0.5 shares, we will be needing a cash outflow of 1000, right? Out of the 1000, we are borrowing 889 rupees, which means I am actually paying 111 rupees from my own income, right? I'm paying it from my own savings. This is my own funds, right? What we refer to as own money over here. Okay, that is, sorry. Okay, that is 111. Okay, so the price of this portfolio is actually 111 rupees. The price of the portfolio meaning nothing but what you have to pay today to get the payoff in future, right? So if you have to pay 111 today to get a payoff of either 200 or 0 in future at T equal to 3, and that 200 or 0 is going to be dependent on the value of the share, right? So if you pay today 111, you will have a chance to get either 200 or 0. The 200 or 0 is nothing but the payoff of the call option as well. Okay. So this portfolio's payoff and the call options portfolio payoff is one and the same. Okay. Both of them are dependent on the share price, but they're going to be either 200 or 0, right? So to get that payoff, you have to pay 111 today for this portfolio. This 111 is going to be nothing but the price of the option. Price of the option is nothing but the premium that the holder should pay to the writer, which means the holder should pay 111 rupees to the writer of the call option today, with the possibility of him receiving either 200 or 0 in future. Okay. And obviously in the live markets, we saw that the price of that call option was 69, Please don't ask me why this 111 is not equal to 69, because there were several assumptions that we took. One assumption that we took was the price of the share at t equal to 3 will be either 2200 or 1800. Who the hell on earth gave these numbers? It was something that we assumed. The market is obviously not going to say that the price is going to be either 2200 or 1800, right? There can be a range of possible outcomes. It can be greater than 2200, it can be less than 1800, it can be anything, right? So this was one assumption that we made. Okay, so this is one reason why it is not going to match with the 69 that we saw. Another thing is, obviously I changed 26th of November to 3 months for my own convenience. I myself assumed a risk-free rate of 5%. Okay, so there were several assumptions that we have taken. So obviously 1169 are not going to match by any means. Okay, they're bound to be different. All right. Now I will just have one additional discussion of what this H is. Okay, H is nothing but delta. Okay, we saw the delta of an option was y2 minus y1 divided by x2 minus x1, right? Where y is the value of a call option, x is the value of a share. If you look at y2 minus y1, which is 200 minus 0, which is 200, divided by x2 minus x1, which is 2200 minus 1800, which is 400. That is equal to 0.5. Okay. So H over here is actually nothing but 0.5. Okay, so if you actually ask me, I initially said that there are two unknowns. First unknown being the value of Y, and the second unknown being the value of H. Okay, to be honest, H need not be found through these multiple equations. You can straight away calculate the value of the delta, and you can substitute that straight away over here, right? So you can, actually call this replicating portfolio as borrow Y and buy delta shares. Okay, the replicating portfolio equation can be changed. It need not be called as borrowing Y and buy H shares. Now you can replace it as borrowing Y and buying delta shares. Okay, so first you calculate the value of delta, and then you calculate the value of Y. Okay, when you're trying to calculate the value of Y, you only have one unknown right now, right? So you just need one equation. You don't need multiple equations. You can straight away put the value of H in the second equation and then calculate the value of Y. Okay, so I think I just wanted to make this one point. Okay, the reason why I used H as is because H is also known as hedge ratio. Okay, reason being, delta is nothing but it ensures, okay, I will, let's take this after I complete the other example also. For now, just remember that H is also called as the hedge ratio, okay? Because hedging is basically nothing but you're trying to create a risk-free portfolio. In what we did in delta neutral approach was when we calculated write a call and hold delta shares, okay, we created a risk-free portfolio, which means we hedged ourselves, right? We hedged ourselves from any movement in the share price. So that is why delta is also denoted by H, which is called as hedge ratio. Okay, I have already given away the reason. Initially, I said that, let us complete the example and then I will give you the reason, but I've given it away. H is nothing but hedge ratio because it hedges your portfolio. When you write a call and hold H shares or hold delta shares, your portfolio is hedged from any movement in share prices. Okay, so how do we replicate a call option? We borrow Y and we buy delta shares or buy H shares. Okay, you can calculate delta straight away as Y2 minus Y1 divided by X2 minus X1, or you can leave that and straight away solve for these multiple equations. It's going to be simple. All right. Let's come to the example that we had. Give me a second. I will just bring the Excel sheet up. Okay, so in our example, we had 50 as the current share price. We had the strike price as 48, RF as 5%, and we assume 6 months as the option maturity. By now, I'm sure that these figures would have been into your blood, but fine. Okay, and the payoff could be either 55 or 45 because we assumed U to be 1.1 or D to be equal to 0.9. Okay, so the payoff from a call option can be either 7 or 0. The share price can be either 55 or 45. The payoff from a call option can be either 7 or 0. All right. So the first step is we borrow Y and buy H shares. Okay, we're doing this today. All right, we're borrowing Y and we are buying H shares at t equal to 0. All right. Now we calculate the payoff of this portfolio. By portfolio, I mean this portfolio, borrowing Y and buying H shares. We're calculating the payoff of this portfolio at t equal to 6. All right. I'll do it in Excel only because I have the format ready. If you want, I'll just take it in the separate sheet wherever I want to explain. But for now, I will be doing it in Excel only. All right. If I borrow Y and buy H shares today, the payoff of this portfolio at t equal to 6 will be, okay, I'm not calculating H as delta. For now, let's say that we'll solve for H using multiple equations. Okay. The payoff of the portfolio is going to be equal to 55 into H, 55 into H. Okay, that is going to be my cash inflow, because if I buy H shares today, I can sell those H shares tomorrow, right? So the payoff of the portfolio at the upper node will be 55 into H because that's a cash inflow. But I will have to repay Y into 1.025, right? Because 1.025, because 2.5% is the interest for 6 months. Okay, so what I have to repay, which is a cash outflow, is Y, which means the amount borrowed today, the principal amount, multiplied with 1.025, which includes the interest. So I will be reducing Y into 1.025. Okay, this is the payoff of the portfolio at t equal to 6 at the upper node. At the bottom node, the payoff will be 45 into H, because I have H shares. I can sell H shares. One share is worth 45 rupees. So H shares is nothing but 45 into H, right? And then I will have to repay the same amount, which is Y into 1.025. Please note again and again that what you repay as borrowings plus interest is not going to matter whether you're at the upper node or whether you're at the bottom node. The only thing that is going to be that is going to affect the value of portfolio is the first one, 55 into H and 45 into H, right? Because if you're holding H shares, the value of that H shares tomorrow is going to be dependent on the price of one share tomorrow, right? At t equal to 6. To replicate the portfolio, what I will be doing is I will be equating the payoff from a call option with the payoff of the portfolio, right? So I'm going to equate 7 is equal to 55 into H minus Y into 1.025, and 0 is equal to, again, 45 into H minus 1.025, all right? Now what I will be doing is assume this to be equation 1 and this to be equation 2. I will be reducing equation 2 from equation 1, all right? Which means 7 minus 0, which is 7. Okay, that is my LHS. And the RHS is going to be 55H minus 45H, which is 10H. And the latter term will get cancelled. All right. If you notice, even in the previous example that we took for Reliance, the second term was getting cancelled. Over here also, the second term is getting cancelled. It's not rocket science. The only reason why it is getting cancelled is because the amount that you have to repay as borrowings plus interest is the same in the upper node as well as the bottom node, right? It's going to be same in every illustration, right? So obviously they are bound to get cancelled, right? So 7 is equal to 10H, right? Which means H is equal to 0.7, which is nothing but 7 divided by 10. H is equal to 0.7. If you remember, 0.7 was what? It was nothing but our delta, right? The delta of the call option was 0.7. So again, I've just shown that H is nothing but the delta of a call option, okay, which is equal to 0.7 in this example. In the previous example, it was 0.5. All right. And also, if you actually notice over here, in the previous example, we actually took an at the money call option, correct? And at the money call option, meaning the strike price of 2000 was the same as the share price of 2000. Over there, the delta was equal to 0.5. Okay. Over here, we've taken a slightly in the money because the strike price is 48, the spot price is 50. So we have taken slightly in the money call option. Okay. The delta of an in the money call option is slightly higher. Okay, because the delta of an at the money call option was 0.5. The delta of a slightly in the money call option is 0.7. The delta of a deep in the money call option is going to be equal to 1. and the delta of a deep out of the money call option is going to be equal to 0. This is what we actually read as well, right? In the beginning. The delta of a call option is going to lie between 0 and 1, and deep in the money options have delta close to 1, right? So as the moneyness of the option keeps increasing, the delta keeps moving from 0.5 to 0.6 to 0.7 to 1. All right. So we have H or delta equal to 0.7. We could have, instead of doing this, two-way equation, we could have straight away calculated the value of delta. Okay. So the second step that I wrote over here was guess what H is. You have already guessed it. And now we are generalizing equation 1. Equation 1 is basically borrow Y and buy H shares. We are now changing this to borrow Y and buy delta shares, right? So it's now you don't have two unknowns. You can, in the examination as well, you can write borrow Y and buy delta shares. You can straight away start with the calculation of delta. Okay, so in that case, you will calculate the value of delta and then substitute the value of delta in this equation to find out the value of Y. Okay, so now that we know the value of H or value of delta of 0.7, let us substitute that in equation 2 over here to get the value of Y. Again, you can do it in equation 1 also. If you want, I will do it in both the equations, and obviously the value of Y has to be the same. Okay, so 0 is equal to 45H. 45H is nothing but 45 into 0.7, right? Sorry, it is 45 into 0.7, which is equal to 31.5. All right, 31.5 okay, 45 into H is 31.5, and the minus Y into 1.025 will go to the LHS to become plus Y into 1.025, right? So I'll just move this to here. Okay, minus Y into 1.025 will move to the LHS to become plus Y into 1.025, right? So I have Y 1.025Y is equal to 45 into 0.07, right? So if you look at this, this is the value of borrowing or value of Y at t equal to 6. Okay, which means basically 31.5 is what you have to pay at t equal to 6. How did we get that? What we did was we moved Y into 1.025 to the LHS. Y into 1.025 is nothing but the maturity value of the borrowing. That is equal to 45 into H. All right. So 45 into H is nothing but 31.5. So this is the maturity value of the borrowing. Okay. The current value of the borrowing at t equal to 0 will be nothing but 31.5 divided by 1.025, because the 1.025 that we had at on the LHS side has now moved to the RHS to give us 30.73. This is the value of borrowing. All right, this is the value of borrowing that you need to take today. Okay, you have to borrow a sum of 30.73. So the replicating portfolio is borrow 30.73 today and buy 0.7 shares. Okay, now let's quickly look at how we would calculate the value of Y at the upper node. Okay, we have 7 is equal to 55 into H. Okay, 55 into H is nothing but 55 into 0.7. All right, we will bring the 7 from LHS to the RHS, which will make it minus 7. All right, and then we have Y into 1.025 on the LHS. Okay, so again it will be this divided by 1.025, which is again 30.73. So whether you use the bottom side or whether you use the upper node, you're going to have the same value of repayment, same value of borrowings at t equal to 6, and the same value of borrowing at t equal to 0 as well. Okay, now what is the cost of replicating this replicating portfolio? So our replicating portfolio is borrow 30.73 today and buy 0.7 shares, right? So if you look at it, if I borrow 30.73, I'm going to receive a cash inflow of 30.73, right? So that is why I'm using plus. Okay, I receive 30.73, but then I have to buy 0.7 shares. For buying 0.7 shares, it is going to cost me 50 into 0.7, right? Okay, so I have a cash inflow of 30.73. And then I have a cash outflow of 50 into 0.7. Okay, 50 into 0.7 is 35. So the cash outflow is greater than the cash inflow, which basically means that I have to pay a certain sum of money today from my own income to actually buy this replicating portfolio. Okay, I have to pay 4.27. We are calling this replicating portfolio because the payoff of this portfolio is nothing but is equal to the payoff of the call option, right? We have created the portfolio, we have found out the values of Y and H in such a way that the payoff of this portfolio is equal to either 7 or 0 at t equal to 6. Okay, so the price of this replicating portfolio is 4.27. The price of the replicating portfolio is going to be equal to the price of the call option, which is nothing but 4.27. So 4.27 is the premium that the holder of a call option should pay to the writer of a call option for giving him a right to receive either 7 or 0 at t equal to 6. Holder is having a right, not an obligation, to buy the share at a strike price of 48, which means his payoff can be either 7 or 0. To get that right, he has to pay 4.27 today to the writer of the option. Okay, and obviously, like we saw, 4.27 is between 7 and 0. The 4.27 that we calculated is the same as what we calculated under delta hedging, and also it will be the same as to what we would calculate under the risk neutral valuation method that we will be seeing in the subsequent lectures. Okay, so a quick summary of what we actually read in replicating portfolio method. First, we saw the no arbitrage principle, which means two securities having the same payoff in future must have the same price today. Then we saw that we are going to create, we saw the overview wherein we said that we are going to replicate an option by using stock and risk-free borrowing. So for replicating a call option, what we did was we borrowed a sum of money, which we denoted as Y, and we bought delta shares. Okay, we bought H shares. H is equal to delta is equal to hedge ratio. Okay, so when we buy H shares, the outflow from H shares is going to be greater than the inflow from the borrowing that we make today. So on a net basis, we will actually have a cash outflow, and that cash outflow is nothing but the option premium or the option price. Okay, so first step is we calculate the delta of the call option. The second step is we calculated the amount of borrowing, which we denoted as Y, preferably done using the bottom node, because the bottom node generally has a payoff of 0. It can have a positive payoff also. We will see illustrations later where the bottom node also can have a positive payoff. The calculation is not going to change, right? If the bottom node has a positive payoff of let's say 1 or something, just like how we did the calculation at the upper node, the same way the calculation will also be done at the bottom node. We will move 7 to the RHS, and this right term will come to the LHS, right? It's going to be the same. It's simple maths, right? Okay. And then we will calculate the cost of replicating portfolio. The cost of replicating portfolio is going to be equal to the value of delta shares, which is an outflow to you, less the amount of borrowing. The reason why I've interchanged this, because I mean, I've called this as the cost, right? Cost cannot be a negative number. Cost of an apple is, you don't say is minus 70. Cost of an apple is 70. Okay, so that is the reason I've interchanged its value of delta shares minus amount of borrowing, right? The last thing is we have assumed that we are borrowing at risk-free rate of 5% per annum. Is that a poor assumption? Is that an unrealistic assumption? Because if I go to a bank, nobody is going to be lending money to me at risk-free rate, right? Risk-free rate is the rate at which the government of India is able to raise money, right? Or the US government is able to raise money. So when I'm saying that I'm borrowing 30.73 at 5% per annum, which is the risk-free rate, is that a correct assumption? It is a reasonable assumption. Reason being, you can short sell a T-bond. When you short sell a treasury bond or a government of India bond, you receive money today, right? Short selling a treasury bond is equivalent to borrowing a sum of money at risk-free rate, because in future, when you short sell, basically what you have to do is you borrow the treasury bond from someone else and you sell the bond in the market, right? You receive money today, and at the maturity of the treasury bond, or once your borrowing term is over, you have to buy that risk-free bond and then give it back to him. Okay, so what you have ensured is you have actually borrowed a sum of money at the risk-free rate, right? So you pay the face value later. Face value meaning the at the maturity. Generally, the bond is redeemed. I mean, treasury bonds are redeemed at face value. So you borrow from somebody today. You borrow the bond today. You short sell the bond in the market. Okay, you receive money, and then at the maturity of the bond, you basically have to repay the face value to the lender of the security. Okay, so essentially, you have done nothing but borrowing at risk-free rate. Okay. Quickly, the formula for Black-Scholes model is also buying delta shares, which is financed by borrowing a sum of money, which is by borrowing Y. Okay. If you look at the Black-Scholes formula, it is nothing but buying delta shares financed by borrowing Y. Okay. And then I wanted to just have a general discussion. In options or in derivatives, we saw that there is implicit leverage, right? Meaning the premium that you actually pay for a call option is very negligible, right? And for a forward or future, we saw that it is virtually equal to zero, right? So inherent to buying or entering into a derivative as a buyer or as a holder is there is implicit leverage, because you're getting exposure to an underlying of 2000 by just paying 69 rupees, right? So that is nothing but implicit leverage. Okay, implicit leverage also means minimum initial investment. It is a very, very important feature for calling any instrument to be derivative. Okay, if you look at futures and forwards, you have no initial investment, but your profit or loss is exactly the same as buying a share, right? Whereas for buying a share, you have to pay 2000 today, and then the profit or loss is yours. Whereas in case of futures and forwards, without paying any money today, you're still able to enjoy the same profit or loss that you would have enjoyed after buying share, right? Okay, without paying money. That's the most important thing. So there is not, that is nothing but implicit leverage, right? Because it is as good as you have not used your money, you have used someone else's money to get an exposure to 2000 rupees of share, right? So there's no initial investment. Similarly, in interest rate swap, there is again no initial investment, but you get exposure to a fixed or floating rate bond. Okay, to those of you who know IRS will be able to link with this. Those of you who do not know IRS, it's fine. And IRS is looked at as a portfolio of long and short bonds. You're able to get exposure to a bond which is either paying, let's say if the notional is about $100 million, you're able to get exposure to a bond of $100 million by paying zero amount, right? You're able to get exposure to a fixed rate or a floating rate bond worth 100 million without paying any amount. So that is also implicit leverage. Similarly, in currency swap also, generally there's no initial investment. On day one, even if there is exchange of currencies, it is done at the current spot rate, such that in the same currency, I mean, if you convert all the amounts into the same currency, your cash outflow or inflow today will be equal to nil. Okay, so even in a currency swap, there is no initial investment. Even if there is a cash inflow or outflow, the net amount is going to be zero at the end of the day. It's just going to be an exchange in different currencies. Okay, implicit leverage is a very, very important feature for calling any instrument to be a derivative. Okay, so without although and if like if a security is deriving a value from an underlying instrument, you can call it per se derivative. But if there is no implicit leverage, then at least from the perspective of reporting, it is not a derivative. Okay, for those of you who have done Ind AS 109 or IFRS 9, okay, if you do not have initial investment, for instance, there would be cases where you might have to prepay your forward, right? In forward, basically what you're doing is you're agreeing to pay a certain sum of money in future, and you're agreeing to receive a share. Okay, if you pay instead of paying that sum of money in future, if you actually pay that sum of money today, okay, it's called as a prepaid forward, right? You pay the money today, but you get the share after 6 months, right? So that is called as a prepaid forward. Prepaid forward is not a derivative for the purposes of reporting. Prepaid forward is actually as good as giving a loan. You do not recognize it as a derivative, you recognize it as a loan. Okay, for those of you who have done Ind AS 109 will be able to connect to this. Okay, I also wanted to cover replicating portfolio versus delta hedging, but I think this video is getting a little too long, so I'll just cut this video here. We'll see this as part of lecture 4. All right. Thank you.